So when these volatility events happen is not the time to make emotional decisions.
And this is why we say have cash.
Have cash and also build a strategy that is meant for all market types.
We co-brand this podcast studio for my military podcast too. And one of the new additions to the podcast studio here is this replica of a 155 millimeter artillery shell, which this is a replica, obviously, because this weighs about 100 pounds in real life.
It does not look like it. I can't believe like security or someone hasn't come up to our studio
when it got shipped here to our old office, when it got delivered, the security people asked me a question about it. I'm like, well, clearly it's fake because it weighs, a pound, right? It's just like 3D printed, but it's an exact replica.
Man.
So yeah. So you think of this like a big bullet. It just goes into a
chamber,
tube, a barrel. And these ogives here are what engage with the lands and grooves inside and so when it fires, it twists like this and goes out. And these markings here denote what kind of, so this is a standard high explosive. M107 is the nomenclature, but we also call it a Delta 544. And then it's 155. You can tell what the millimeter is. Not that anybody would mistake it for another.
Right.
And then the squares are actually tell you how much this weighs in artillery speak relative to a standard weight. So if there are 4 squares on there, you would know that this round, when it was manufactured, came out heavier than standard weight. And you have to factor that in when you shoot this.
Sure, with all the...
Because manufacturing processes are different for everything. And then this top part is called a fuse. So this fuse is what we would call it. You could select it between a proximity fuse, which means it would detonate at some level above the ground, little radar in it, like tells it
right,
or point detonate, which means when this thing feels an impact of the earth, then it explodes. So
well, now I know you went to school for this.
There you go.
Like you don't just get to show up and shoot it day one.
No. There's like a whole ballistic science behind this, because like when we fire this thing, it actually has to be calculated for things like wind speed, wind direction, temperature of the ammunition, the propellant behind it. If you're out in the desert and the propellant is hotter than if you're in Alaska, the velocity is going to be different. Each tube has its own wears of the lands and grooves, so each tube has a different muzzle velocity.
It's all physics.
It is all ballistic trajectory. We actually calculate things like the rotation of the earth underneath this thing while it's flying through the air. There's a whole lot of science that goes into it.
See, and I know what that is. So I watched the movie Shooter recently with Mark Wahlberg, where if you haven't seen it, great movie, Coriolis effect.
Yes, right? Yeah, it's like you have to, the spin of the projectile. It's all, and I think the scariest thing for listeners is to think that like I was entrusted with figuring all of that out, right? And I'm the guy that can't do math in my head. So.
Well, thank God for calculators, because I'm the same way. I still do 2 + 2 = 4, even though I can do things like that.
No confidence in my mental ability to do math. It goes all the way back to 3rd grade and multiplying the multiplication tables. So, but welcome back.
Yeah, you're not doing any math.
Yes. Well, welcome back, everybody, to your quick orientation to artillery in the military and off the wall. So we are here for another round, but take it away, Nate.
Yeah, no, we're here for another AMA episode. Ask Monument anything. Right now, there's a lot going on. We've gotten a lot of questions. I think we were kind of able to distill them together, blend them together to really get 3 topics that are very top of mind right now.
Right.
Just as a quick reminder, we always like to say this. We're recording on March 20th today.
Yep.
So March Madness in full effect. A lot of madness can take place before you listen to this.
Okay, time out. So I'm in 3 brackets.
Oh,
okay. The monument bracket. Okay, the monument bracket, which is fun, and I'm middle of the pack there. But I'm in another bracket with some of my idiot Marine buddies. 60 of us. I'm number 1. Knock on wood. I have a perfect bracket through the first day. Perfect. Got everything.
Hopefully you entered the Warren Buffett $1 million challenge.
I did not, but if I win it, because there's such a low probability of having a perfect bracket, I'm just going to reach out to him and say like, hey, I know I didn't sign up for this, but maybe you could like, throw me a bone.
Exactly.
And if I did have a perfect bracket, I'm playing the Powerball for the rest of my life.
I think
Clearly, I'm that lucky.
you definitely should. I think the odds are like better than you're more likely to get struck by lightning multiple times than have a perfect.
I'll be on CNBC as the guest of like the best guesser in the world.
I love the title.
All right, what do we got for
Yes,
questions?
I know we got to get back on track here, but so the questions we got today, I think again, given the Iran conflict, a lot of it is around that. So I think the first two topics that we have to talk about are if oil prices continue to spike even higher, what does it mean for inflation? What does it mean for rate cuts?
Right,
The second one is, do you think that this Iran war and the market reaction will be similar to past conflicts?
right.
Is this just going to be a dip with a recovery very
Yeah.
quickly, or are we seeing a more structural shift within it?
And the first two questions are kind of they're
They
a
are.
little bit related, so we may just roll right into like both. But yeah,
I agree.
there's a connection there.
Yeah, and then the final one is something that I think we're hearing a lot about. I'm not sure if it's made its way quite all the way down to retail investors, but what are and what's happening with private credit funds?
Yeah.
We've talked about that in previous episodes, so it's almost kind of an update to what we talked about, I think maybe last year. So we got three topics, like you said, two are pretty linked.
Yeah.
And I don't know about you, but I think that makes the most sense to start with those.
Yeah, let's go for it.
All right, so let's start with the oil one. So just remind everyone, oil has moved higher.
Mm-hmm.
If oil spikes even more, price continues to go up.
Mhm.
What's going to happen with inflation? What's going to happen with the federal rate cuts?
Yeah. Okay.
So Dave,
I mean,
break it open.
yes. If oil goes up, it has been going up. It is going to have trickle down, flow through, impact into inflation.
Yeah.
Okay. I think the question is for how long. And the other thing that, and I don't have an answer to this so much as I have like a question that just conveys that I'm thinking about this, but with employment not doing all that well and people having a hard time getting jobs in AI, is it possible that when we look at rate cuts, you say like, well, one of the reasons that they don't want to cut rates is because inflation is high and we don't want to stoke higher inflation. But at the same time, if rates don't come down and you don't try to create what's going to happen on the employment front, right? So like
Fair
the
point.
Fed has two mandates and there seems to be this is just Dr. Dave, the unlicensed and unschooled economist, says that those two things are in a tug of war with each other.
Yeah.
So I'm watching that because I also think, and you can go back and read blogs from 2 or 3 years ago, like a lot of this inflation stuff, especially what we saw during the Biden administration, was just a function of like COVID money hitting the system. I don't think it was an economic, the economy on fire was causing the inflation to go up. I think it was simply, you know, M3. I just think it was money. It
Yeah.
was money in the system.
The money supply, right?
The money
I mean,
supply. Yeah.
money is a commodity,
Mhm.
kind of just like oil. If there's more of it,
Yeah.
inflation tends to go up. And that's really what happened in post-pandemic.
Right.
This is a little bit different, why inflation is rising,
Yeah.
right? Because oil goes into every bit of the economy. And the main reason there is just transportation.
Yep.
So even if it's not, oil that gas that you put in your car or use to heat your home, everything is dependent on being able to transport goods across the country.
Right. These glasses are going to become more expensive because they're made out of plastic.
Correct.
Right? I mean, it's everything.
Yeah, and then they're going to be more expensive because someone had to drive to the warehouse to pick them up. It just goes through everything. And so, again, if oil prices continue higher, inflation is going to move higher.
Right. Right.
And I think it's interesting when you look at what there was a Fed meeting a couple of days ago from recording. Inflation expectations are moving up. There's no way around it.
Yep.
The Fed is expecting higher inflation, but not significant. I think if I saw, just to check, I'm checking the numbers here. Yeah, 2.7%
Okay.
annually.
Right.
They projected
A far cry from where we were a few years ago. Right.
I
Right.
forget how high it
Yeah.
got, but it was unbearable. 2.7, it was previously 2.4. So we're talking marginally more inflation.
Yeah.
It's not going to break the system. This is not a COVID kind of style of inflation.
Yeah.
What it really is about is it's going to be temporary as well, because I think a lot of the things that people are forgetting when we kind of look at how the Fed is going to react to this, they look more at measures of core inflation,
Right.
which is different than headline. Headline inflation includes all categories.
Yeah.
Core inflation excludes food and energy prices. It's a more stable measure because those are so volatile, the food and the energy, as we're seeing.
Mm-hmm.
So they know that this might be a temporary shock. And I think that's kind of a dirty word in Fed land. This is transitory inflation
Right.
because when oil comes back down, and
Yeah.
it will eventually,
Well,
inflation is gone.
think about it all from the perspective of supply and demand as well, right? So,
Sure.
like, one natural cause of inflation is there is more demand than there is supply for an item, so the price goes up, right? Okay. I don't think that beef prices are going up
Hmm.
because everybody's running to the store and buying ground beef, and there is a demand component that is outstripping the supply.
Yep.
I think it's input pricing and everything else that's right. So when those input prices come back down, I think it's temporary.
It
I
is.
don't think this is a demand. Inflation isn't a function of massive out of control demand driven by people having so much money that they're just out buying more ground beef. It's like
For
the
sure.
eggs, a year ago or something like that. So I'm watching this thing. I don't think it's a panic mode. There's a lot of people out there who have really good justifications for why we shouldn't lower interest rates. Then there's a lot of people out there with some really great justifications about why we should lower interest rates. I, personally, I would like to see interest rates come down a little bit.
I think everyone would.
Yeah, I just,
Everyone in the business world does want lower rates. We
right.
can't ignore that.
Mhm. Yeah.
Now, I think when you look at it, similar to like you said, you're watching it. Guess who else is watching? The Fed. They said that. They're
Right.
still data dependent and they don't want to have to reverse course. I think the last thing they want to do is cut rates. Inflation does get worse.
Mhm.
Let's just play the hypothetical. And now they have to hike. Oh, I don't want to be at work that day. I
Right.
mean, because again, that's going to be chaos in the markets.
Yeah.
And I mean, all of a sudden now, I think the markets are listening to what the Fed said and are actually more hawkish. And
Mhm.
hawkish meaning they think there's actually less rate cuts in the future now.
Right.
The market after the Powell press conference totally priced out any rate cuts until mid 2027.
Right.
They think, again, the Fed is going to be patient. And that's not a bad thing
Yeah.
because if the Fed does cut and the market doesn't think a cut's coming, that's positive. That's a tailwind for the market.
Yeah.
So really, again, we're in wait and see mode. And again, I think to your point, it's going to be that tug of war again. We're not going to know until we know kind of the situation here because they are data dependent.
Right.
So rate cuts are probably delayed. It's going to depend how things go, but I don't see oil being the reason, I guess, why the Fed is all of a sudden going to have to start hiking.
Right.
It just puts them on a pause for longer.
Yeah. So see what happens. I mean, like, you and I were talking about this the other day, and I don't know if you could quickly pull it up as I'm making this point, but the the futures
Hmm.
market for oil doesn't seem to think that this is gonna last very long.
Correct.
So I don't know if you could
Yeah.
what's the futures market saying about oil 6 months from now?
Yeah. So right now, oil's at 97. If you look at it,
Today.
West
Right.
Texas Intermediate. I always have to pause on that because I mess it.
WTI.
WTI for all the acronyms. If you go 6 months out, so what would that be? September.
Sure.
In September, it's down to 82.
Eh,
It's down to 80 in the following month, October. And
mhm.
by the end of the year, $77.
Okay, so that's what everyone that is a collective measurement of what but I won't get into how futures markets work. So basically, like, what is somebody willing to buy something in the
Correct.
future for a price today? So basically what that's saying is that most people in the market don't think that we have some sort of massive supply problem of oil or an over demand of oil. There is a temporary shock to the system that most people think will be washed out by fall.
Yeah.
So
And
I'm going with that.
yeah, I would too. And I think just to wrap up the point here, I think when you're going to hear some of these things in the news. The United States has not released any oil from their strategic reserves. So if they actually start running into long-term pain, they still have that lever to pull.
Right.
The Strait of Hormuz, which is the key choke point that everyone is so focused on, while it doesn't seem like maybe escorts are going to happen, that doesn't mean they can't happen when the pain gets so bad for everyone
Mhm.
else. And I think then again, the thing that jumped out to me most recently is Israel's now come out and said they're going to stop attacking the energy infrastructure.
Yeah.
We'll see if that holds. I know a lot of things can change quickly, but all of those are already moving in a positive direction for oil just to calm down. And I think the market understands that this is going to be a temporary thing.
Right.
So it's easy to overreact, to think this is a COVID environment. This is not COVID.
Right.
This is very different. And there is more likely to be transitory,
Right.
if you ask me.
Agreed.
I think it's a perfect segue into our second question because, again, I
Yep.
think a lot of investors are seeing the volatility in stock markets, stocks going up, going down, mostly down. So, with the second question here, do you think because of the Iran war and the market
Mm.
reaction, is this just a dip and a quick recovery? Or are you thinking about this as the market has structurally changed?
Yeah, I think, well, a little bit of both.
Okay.
Now, this is just like without getting seem to be getting off on a lot of military tangents in this podcast.
I'll try,
But it's
I'll try
current
to keep
events,
you on the
right? Current
course.
events. As I was driving into work today, March 20th, I heard a clip from the president saying, "I'm not putting boots on the ground." I think boots are going on the ground.
Okay.
They're not sending 2 Marine Expeditionary Units with 2,200 Marines each into the Gulf to just steam around.
To sit on a boat.
It would be strategically ridiculous to say we're gonna remove the, projection of power that we have in the the Indo-Pacific region where we're worried about China and the island chains and all that,
Mhm.
and as a deterrent to escalation with Taiwan or whatever scenario you wanna come up with, and we're gonna take that asset out of the Indo-PACOM region and put it into the Gulf as a second group of 2,000 Marines. Because last week, a group of Marine of Okinawa, Japan, started steaming to the Persian Gulf and with the USS Tripoli. And now another Marine Expeditionary Unit that has come out of San Diego and the USS Boxer is also heading to the Gulf. So you've taken both of the major deterrents in the Indo-PACOM region out and put them into the Gulf, and you're not doing that just to do it.
Yeah.
So Marines are gonna go ashore somewhere.
And that
I
probably means more market volatility.
Exactly, exactly. However, I think in the long term, okay, what if there is a regime change or whatever it is, and you to listeners who are out there, pounding their fists against the windshield right now, you have to divorce yourself from your political perspectives on things and look at this from a military strategic perspective for a second for what I'm about to say to make sense. So this isn't a political statement. It's just like if
Mhm.
you're a military strategist, this is what I'm talking about. What if there is a regime change? Because personally, I think the military campaign, whatever your opinion about it is, right? And here's my opinion about opinions. Everybody's opinion is right
Correct.
to themselves.
Yeah. Oh, yeah.
Like
You're the hero of your story.
I don't try to change people's opinions. So everybody has opinions. And that, okay, so what if, so hold your opinion constant. What if there is a regime change? And what if that new regime becomes globally friendly and now all of a sudden Iranian oil is no longer sanctioned and isn't only purchased through a shadow fleet by Russia and China, and it becomes available in the world market to everybody?
Yeah.
Then what happens? And then you start increasing your supply coming out of Venezuela. Like, you could actually see oil become so abundant that the price actually goes way down.
Below where it was pre-conflict.
Right.
Yeah.
Mhm.
I think so. What I'm hearing from you, so I'm going to put words in your mouth. You can correct me if I'm
Sure.
wrong, is you see this more as a temporary dip.
I see it as a temporary dip with long-term, maybe positive implications achieved through something that is unfortunate, which is warfare.
Correct.
Yeah.
And painful, not just, and in a lot of
Right.
ways, right? From the human capital,
Yeah.
also from the markets, because I think that's where I land roughly. I hadn't actually thought about the long term. That's a great point about if you do get the supply, can we see oil go lower than it was before?
Right.
And an openness to trade. Global trade is important. I'm not a tariff man, again, putting all politics aside. So
Yeah.
opening up a global trade is great. And think about it. I think tariffs is actually maybe not obviously the same thing, but this is also, I think, a very similar thing. When the tariff tantrum that happened last year in April around this time, markets went down rapidly, but they recovered rapidly.
Yeah.
I kind of see the same thing with this conflict because so much of it happened so quickly, the markets had to quickly reprice for a new outcome.
Right.
Eventually, they're going to have to quickly reprice for when the outcome or conflict, a ceasefire, oil starts flowing again, the prices
Sure,
come
like,
back down.
look at what happened when the Red Sea opened back up and the Houthis stopped shooting missiles at oil tankers going up through the Red Sea. look at what happened after the Venezuela conflict was quickly. I mean, like we have these shocks to the system that are caused by news events. I think this one is a little bit more extended than some of
Sure.
the past things, but it will come to an end. And like I said, possibly. And if you remember back when we talked about Venezuela weeks ago on Ask Me Anything, and I was like, hey, a lot of this isn't just about Venezuela, it's about Canada with their oil production. And if we start bringing in the heavy oil, then they kind of lose as a market. It could bring oil prices back down, right? And then I was talking about like how this could impact Cuba and everything. I
Yep.
mean, this is a big puzzle thing that's being
Correct.
put together that, frankly, I believe goes all the way back to last year when we had the very limited bombing campaign against the nuclear site in Iran. Remember, it
Yeah.
was a one-day strike where I think all that did was buy the administration time to put the chess pieces into place to be doing what's happening now. And I think that this will end, maybe not tomorrow, maybe tomorrow,
We don't
but
know.
at this point, and again, the opinion beating on your windshield, I get it. But like from a military perspective, this has been an extremely successful military. I mean, we've lost 9 aircraft,
Mm-hmm.
and 3 of them were shot out of the sky by friendly fire anti-aircraft. Okay, so I don't really count that as a combat loss inflicted by the enemy. We lost the tanker in what I believe to be a refueling accident inside of
Yep.
Iraq, so again, not that. Iran has been successful in shooting down some Predator drones, but that's exactly why we have unmanned aircraft, right? I mean, like,
Yeah. Well,
it
and I mean,
great. They shot down aircraft that don't have people on them.
it
So
was never going to be, again, a zero cost event.
mhm,
And I think that's where, when I talk to other investors, staying invested is so important. Because to your point, we're not going to know when the conflict ends, but you're going to want to be invested when
I
the conflict ends.
right,
So when these volatility events happen, is not the time to make emotional
and
decisions.
this is why we say have cash.
Have
I
cash
just
and also build a strategy
mhm,
that is meant for all market types. And I know that sounds really good and it's not being Pollyanna, but again, what we do here at Monument is we have strategies that, whether the market is going up or going down, we're looking at the data points, the same data points in each of those environments to dictate which parts of the market to be invested in.
right,
So we're never saying, oh, we got to go to cash now. Oh, you have too much stocks. We need to reduce it to bonds.
mhm,
It's more within your stocks, within your bonds. Here's where you should be invested. Here's
mhm,
where we should avoid. And during the declines, hey, these parts of the market are going down slower than the rest.
right,
Let's ride this out. So when the recovery does happen, you're still invested.
right,
Too many investors continue to try and time the market. They think that they can reduce their risk and get back in. You're going to miss that rebound. You have to stay invested. And this is an example of, even if the market does structurally change, like you were talking about, that's the benefit of being long term. You never got in and out of the market. So while I think it's going to recover just as quickly as it went down, make sure you're in the market to capture that.
right. I mean, without volatility, there is no growth. Okay,
True. Straight line
so
doesn't happen.
so if a world in which you have an investment that has 0 volatility is called the interest that you get on your checking account, which is like 0.
Which is
So, right, so that
ridiculous.
just goes to show you, like, okay, so your people are invested in the market because they want their money to grow. There cannot be growth without volatility. So when you hear people talking about volatility on a daily basis, it's like somebody getting on TV and saying like, "Wow, there sure is a lot of gravity today."
Yeah, I love that. I love when you say that. That's one of my
Just
favorite.
right, so you have to accept that these things are gonna happen, and I'll rewind and say, like, people who called up their advisors or called us up and said, "Hey, I'm getting a little bit low on my cash reserves. It's the first 2 months of the year.
Hmm.
It's the middle of February. The markets are all up nicely, 7, 8%-ish, where depending on where you are in the market. Like, let's raise some cash." And you did that, and you raised the cash, and now the markets are down 5% because of everything that's going on.
Yeah,
You're like, you don't care.
agreed.
You
You
don't
just
care.
wait it out.
But if you did it the opposite, if you're like, well, the markets are up 8% and I am a little bit low on cash, but let's see if the markets keep going up a little bit more, and then they don't. And now it's March 20th and markets are down 5 or 6, whatever, depending on which index you look at.
Yep.
And you're like, but you're still low on cash because you didn't replenish. And now maybe you're forced to adopt a cash replenish strategy when the markets are down a little bit. And that is what you want to avoid. It's just That's one of the very basic silver bullets of investing is don't sell assets when the market's selling off because you need cash, plan in advance.
Correct. But when I look at it, right, I think we always talk about this, and it's a good statistic that every investor needs to remember. A 5% decline on average happens about 3.5 times per year,
Yeah,
3 to 4 times per year. You want to avoid not selling during those. And
that's right.
I'll take it one step farther.
Yeah,
10% decline, that happens at least once a year. You really don't want to have to
right.
sell during that.
And yeah, and we should really publish something. We should put something on social media or something about this because there's a great graph of this.
Hmm.
It's just the way it is.
It is.
There's a lot of gravity today.
Going back to all of 1928. So it's just avoiding being a forced seller at bad
Right.
times. And then you will be so much more successful in any kind of investing in
Yeah.
that regard. Any more dead horses you want to beat?
Let's beat the private credit dead horse.
Yeah, right. So I think the final question we have today, and we'll do a little bit of a jargon breakdown here because I'm not sure everyone is familiar with these. They've gotten very popular. So what are private credit funds and what's happening to them?
Right.
So I think if I can kind of just level set us here. So a private credit fund is usually issued by a large bank, a large financial institution. And what it is it's investors give money to the bank, and the bank then uses that money to make loans in smaller companies that maybe can't get traditional financing. So, what they do is they write these startup companies mostly. They give them money, and the startup company pays a high interest rate for that kind of lending. So why investors really liked these previously a few years back, and we've recorded, I think, at least 2 episodes within the past year about private investments and
Right.
private credit is
Private credit, which is a component of a private investment, right? Because
good
there's other,
point.
right.
So private credit is private debt. So again, the company borrows money. They have to pay 10% to the fund that all these investors invest in.
Right.
So you might get a 10% yield on your investment from lending to this company that candidly might be a little bit more risky.
Right.
Now, the big, I think, downside with these funds, because 10% yield is great, and it's usually got some tax benefits. We're not going to get into those really too much, but 10, maybe 12% interest yield is a good thing for a lot of investors. But in order to get that, you got to give up your liquidity. These are illiquid investments, meaning they usually only allow you to redeem the money that you've invested in the fund once a month.
Mm-hmm.
They also cap the investment redemptions. So meaning, even if you say, I want all my money back, if all the investors that are in the same fund as you want their money back, you may not get all your money.
That's right. Right.
So there's that trade-off. So private credit, just to break it down really simply, you're giving up liquidity to get a higher yield on your investment.
Right. This is a very basic example.
Yeah.
What's more risky if Monument Wealth Management needed $1 million loan or Lockheed Martin needed $1 million loan, right? Like,
Correct.
okay, we're a small business. So there are other small businesses out there. And I'm just going to use a classic printing press because they're big pieces of equipment, right? So if a company that does printing, which by the way, there's not a whole lot of companies that do this anymore, but right. But imagine this company needs to buy a lot of machinery, okay, because they're expanding. So they go to the private credit markets and they say, we need to borrow money to buy these printing presses. Okay, great. So investors say, yeah, I'll do that. But you have to pay me a lot of interest because your small business is risky and the liquidity issue. So, okay, so the printing press company does really, really well. And they pay their loan back and they pay the 10% interest and all the investors are really happy. And that's great. And 9 times out of 10, that happens. Especially if it's an asset-based, like the printing press held is better, right?
Exactly.
But if you are somebody who lends, like invests in private credit, which is lending the money to the printing press company, you say you need your money back, they can't give you the money back unless they sell the printing press. That's why the things are illiquid, right?
Hanks their business, right?
Exactly. So I think one of the things that is happening in private credit is people were sold these investments that sounded like a good idea by people who are like, hey, I've got an idea for an investment, right? Which is a red flag for anything I was saying. Like, I was trying to think of a nice way to say it, but like anytime somebody hears like, hey, I've got a great idea, like you should like immediately turn your radar systems on. But so I've got a great idea. So, okay. Then they don't really understand the plumbing.
Mm-hmm.
and they get caught up in this. Now,
Correct.
for people who do understand the plumbing and don't have a need for liquidity and everything else, there's there's still some things blowing up, and that's a problem. But I think that this panic, because now it's in the news,
See, yeah, you're hitting exactly where I wanted to go.
in the news, and this panic can create some opportunity for people who have a process, right? So the the twin sibling to the private credit markets are the
Mm-hmm.
public credit markets, right? Business development companies. And these things have been hammered,
Yeah.
like down 50%. By the way, they're all still paying their interest. They're all still paying the dividends to the investors. You can just buy these things at a 50% discount right now. And if you understand the plumbing and you do research or you hire people who do the research on a portfolio like this, and you see a portfolio that has very low default rate, is paying all their bills, and you could buy it for 50 cents on the dollar, like there's actually a case to be made for investing in the public version of the private credit, which are business development companies that are
Sure.
essentially the same thing. So I think there's a lot of opportunity out there that's getting lost in the noise of the private credit
Explosions.
155 round going off right on top of it.
And I think that's kind of, it's really,
I keep this here for all. I mean,
let me say, why not? Right. It's a really cool thing. And if you're not watching the video, you definitely got to tune into this one.
right.
Because you're going to see something that you're going to be like, they have this tiny little thing. No, it's a legit round. I think the bigger thing here is like what you're talking about. It's getting caught up in the media.
Yeah.
So even investments that may be good funds, because really I think the big thing that kicked this all off is you mentioned the printing press.
Right.
So when they got that loan, the asset that they purchased, the printing press, was pledged as collateral.
Right.
Well, there were companies out there that were going to multiple banks and pledging the same printing press or collateral to all these different banks. Well, now 5 banks thought they had sole rights to this collateral. Find out, oh, I have no right to this. They already gave it away. I have no collateral. So that kind of kicked everything off. And then you get that story about, I think,
Right.
a lot of companies that were being lended in some of these funds were software companies.
Yes.
And software has been crushed as a industry this year.
Right.
If you
There's
look
no asset with, I mean, there's
IP,
no, right. It's
I-
collateralized.
correct.
It's
So
hard to collateralize IP.
it's impossible. Like what? That's why I own your formula that didn't work, and you're shutting your business down. That's useless,
Right.
worthless. So again, so now you have these overextended companies that were pledging collateral to multiple banks. You have a lot of concentration in a space that went underwater quickly.
Yep.
And now you have the investors wanting all their money back, creating liquidity issues for these funds. It's a very tough environment if you are one of the issuers, which again, they could be Apollo, Ares, KKR, and I'm just naming a few.
Sure.
I mean, for years, I think at Monument, we've been getting pitched that these are great investment ideas and every client needs it by almost everyone in the industry.
Right.
We haven't really done any, I think. And
No, we have a business development company segment to one of our portfolios,
correct.
which I just was like, look,
Yeah, but
that may be where the opportunity actually lies right now.
correct. And
Hey, I've got a good idea.
yeah, right. I see it. Right.
Right.
Now my radar. But we value liquidity at Monument with our cash planning, with everything. Those never enticed us. And I think investors who did maybe get enticed by it are seeing that there's a cost.
Yep.
And that's where it's getting into the news, is they're really running into multiple headwinds at this time. And eventually it'll all calm down. The bad loans will be written off the books. They'll adjust their values. Investors who want their money back will get their money back, even if it takes 1 to 3 years. But eventually there's going to be opportunity again.
Yeah.
Because small businesses who maybe can't get, again, traditional financing need a place to get money to grow. You can't grow without debt, without leverage.
Right.
I think that is something that is so unique about the American economy versus the rest of the world. The rest of the world has a big aversion to debt. I think Americans, when used correctly, I need to pause here, they understand that if you want to grow, you need debt and you need leverage, even on a personal level, on a business level. It does take money to grow money.
Right. So I'm going to wrap up this segment with this comment, because driving in today and yesterday, I started to hear news about how some banks were actually now creating investment baskets that allow hedge funds to short the private credit market.
Yep.
right? So you see Goldman, JP Morgan, Bank of America coming out now and saying, like, we have created an investment to go against the investments. And I just think to myself, like, I'm so glad that we didn't get into the private credit stuff. Um, and I do think that there is some benefit to private credit.
There can be. Yeah.
Right, like, I go back I'm gonna use the printing press example, but it could be anything. It could be a company that makes red Solo cups, right? I mean, look, there's probably still some great
Hmm.
reasons to lend a company like that money. But the software stuff with no collateral, and I don't know what was going on with the underwriting departments that were collateralizing things 5 times. But look, I just think that that's it. However, as a theme, if you still like that, the public credit markets are there. I mean, I'm sorry, the publicly traded markets, they are there
Yeah.
with the BDCs, and those things have been hammered down to 50, 60%. Like, if you're interested in credit, look at that.
Correct. Open up that
Look at that,
universe
right?
and
Don't be locked up because you can sell a BDC just like a stock, you sell it the next day.
correct. The liquidity factor
Right.
isn't there. So you get, again, some of that reactionary
Right.
prices. They might get swept up in other things. But,
Yeah.
and again, I know I'm talking badly about private credit and things like that. And I'm kind of hammering on it. But I
Well,
think
because it's in the news.
it is.
Like, we gotta talk about it.
It is. It is. And I think a lot of people had it. They talked about bringing it into 401k plans. But I think to be completely fair, there are times it does make sense for people. If you don't need liquidity, you can handle some of this extra volatility for extra yield. If that's what you want, just know what you're getting into. And I think that's why we didn't get into it because I don't want to say we predicted this, but we knew this was a possibility.
Right.
And we didn't want to have to deal with the negatives of this possibility that we're
And
full.
we are dealing with the negatives a little bit because we do have a strategy that
Sure.
invests in business development companies. But I look at it like this. As long and this is to anybody who's considering this, as long as the BDC doesn't have a default risk associated with it, and you just have to hold these things because even though the price has gone down,
Mm-hmm.
I'll use the analogy of living in your house. If you buy a house for $400,000 and then it's worth $800,000 and somebody comes to you and says, "Hey, I'm willing to pay you $400,000 for your house," you say, "No, because I'm still living in it.
Correct.
I'm
Right.
getting value and use out of it." So it's the same thing. Like, there's value and use out of a B just because the price has gone down. If you bought it as an investment stream and the default risk hasn't, their ability to cover the dividend has not decreased, do not sell that thing.
Yeah.
Just keep clipping your coupon.
If you bought it for
Quotes.
yield.
Right. And just keep cashing your checks.
Yeah.
In the market, those things will come back because systemically there's nothing wrong with them. They're
Correct.
not defaulting on their loans.
As long as that underlying loan book's right.
Right.
And that's where the research comes in.
That's exactly right.
We can't paint with too broad of a brush. So
Well, I think that brings us to the end, right?
I think so. So, I mean, as always, we appreciate everyone who stuck with us through everything with all the explosions. And again, if you didn't check out the video, this is one I highly recommend that you do. Not only because I do love our new studio, but Dave's new prop is probably going to be one of our
See what
favorites.
else I can bring in.
Yeah, we'll have to.
Yeah.
And as always, if you want to be kind of on our next AMA episode, you have questions that you're wondering about, you can send us an email at offthewall, all one word, at monumentwm.com, or just drop a comment. We're always watching them for
Or
questions.
send us an email or anything. But we love getting the questions because it kind of feeds the whole topic of conversation here today. So
Yeah.
thanks.
Otherwise, we're going to spend 2 hours on military topics.
Well, we could, but then, yeah, everybody can listen to my Moments of Leadership podcast to get their fill of military stuff.
Exactly.
Yeah.
So, well, hey, thanks everyone. That's another episode of Off the Wall.
Thanks.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor's registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.